One thing that surprises many retirees is how often a small tax number can change the outcome of a financial decision. It might determine whether a Roth conversion makes sense, whether your Social Security becomes taxable, or whether your Medicare premiums increase 2 years later. Hi, I'm Mike Heatwole, founder and CEO of the Dala Group, a wealth management firm focused on helping retirees. Today, I want to walk through a few of the 2026 numbers that matter most in financial planning. Let's start with tax brackets. In 2026, the federal brackets adjusted again for inflation. For married couples filing jointly, the 22% bracket now tops out at $201,775 of taxable income, and the 24% bracket runs up to $403,550. So why does that matter? For many retirees, the 22% tax bracket is the planning sweet spot. This is where we often do Roth conversions, manage capital gains, coordinate Social Security timing, and stay below certain Medicare thresholds. Once income moves into the 24% bracket and beyond, taxes can start compounding in ways people don't always expect. So, the real question isn't just what bracket are you in today, it's whether income is landing there intentionally or just happening by default. There has also been an increase in the standard deduction. For 2026, it is now $32,200 for married couples filing jointly and $16,100 for single filers. If you are over age 65, there is an additional deduction on top of that. So, why does this matter? Because the standard deduction often determines things like how much of your Social Security becomes taxable, whether Roth conversions create actual tax or simply fill unused space, or whether itemizing deductions even makes sense anymore. Many retirees are surprised to learn that even with charitable giving and property taxes, they are still better off taking the standard deduction. And that changes how we think about withdrawals and giving strategies. Capital gains are another area that shapes retirement planning. In 2026, married couples can recognize up to $98,900 of taxable income and still pay 0% on long-term capital gains. That can be a powerful planning opportunity. It's one reason brokerage accounts often become very useful in the early years of retirement, especially before Social Security and required minimum distributions begin. When this is handled thoughtfully, capital gains can fund spending with very little federal tax. When this is handled poorly, they can push income into higher brackets and trigger Medicare surcharges. It's the same tax code, very different outcomes. Now, Social Security also adjusted its earnings limits. In 2026, the earnings limit for someone below full retirement age is $24,480. If you claim benefits early and earn more than that amount, Social Security withholds $1 of benefits for every $2 over the limit. In the year you reach full retirement age, the higher limit is $65,160 before the earnings test applies. These numbers matter because we often see people claim Social Security while they are still working, not realizing a large portion of the benefit will be withheld temporarily. That doesn't automatically mean filing early is wrong, but it does mean income timing should be coordinated rather than decided in isolation. Another number that catches people off guard is Medicare IRMAA. IRMAA stands for Income-Related Monthly Adjustment Amount. In 2026, the base Medicare Part B premium is $202.90 per month, but premiums increase significantly once income crosses certain thresholds. For married couples, the first IRMAA threshold begins at $218,000 of modified adjusted gross income, and those premiums are based on income from 2 years earlier. That means a large Roth conversion, capital gain, or bonus today can quietly raise Medicare premiums years later. This is why tax decisions rarely stand alone. Each decision tends to create a ripple effect. For individuals still working, retirement contribution limits increased again in 2026. The 401k elective deferral limit is $24,500, with additional catch-up contributions available for people over age 50 and enhanced catch-ups for certain age ranges. These increases are helpful, but only if they are aligned with your overall tax strategy. Maxing out pre-tax contributions isn't always the best move if you are already facing large future required minimum distributions, IRMAA thresholds, or Social Security taxation. The numbers themselves are simple, but strategy around them is what matters. Estate and gifting limits also increased. In 2026, the federal estate and gift tax limit Lifetime exemption is $15 million per person, and the annual gift exclusion is $19,000 per recipient. These numbers won't affect everyone, but for families who are impacted, they represent planning opportunities. These thresholds often guide conversations around gifting strategies, trusts, and long-term legacy planning. Here's the bigger idea I want to leave with you. These numbers are not just technical details in the tax code. They can influence your personal financial decisions. When you retire, how comfortable you feel spending in retirement, when you claim Social Security, and how your income is structured over time. When you start to see how taxes, investments, Social Security, and Medicare interact with each other, planning tends to become much clearer. If you found this helpful, please like the video and subscribe for more financial planning insights. Thanks for watching, and we'll see you next time. Once again, I'm Mike Heatwole, founder and CEO of the Dala Group. If you are interested in seeing how we help our clients, visit us at www.thedalagroup.com. Give us a call or schedule a time to connect with one of our wealth advisors. We would love to hear from you.